Hey everybody, the accountant here. I want to thank you personally for watching my other video. This is a follow-up video, and let's get started. I've had a lot of interesting comments. I've learned a lot from all of you. I really appreciate your feedback. Same thing for this video. Like it, comment below whether you disagree or agree with my take, but let's get started. So out of all the comments that I've gotten, I have gotten some hate from the Bitcoin community. Not surprising, but I want to make a point here that will build the basis of why I made my other video in the first place and why I'm going to make this one and probably still continue to make videos for the cryptocurrency community, because I believe there's a severe lack of understanding of what has transpired from 2008 to now. So let's read one of these comments. LOL XRP, just as well go back to the US dollar. Obviously, you don't understand why Bitcoin was started or understand what decentralization is. Cat's out of the bag, and it would take a global effort from all countries to stop it. Well, as you'll see in this video, there is a global effort to stop it. But let's back up and actually talk about the point of why Bitcoin was started. So I read the white paper in 2008, believe it or not, and I know the reason why it was developed. It's part of the reason why I made my original video, because I find this so interesting that things have changed so massively over the span of the 12 years. As you can see in my previous video, I mentioned the end of Bitcoin. Well, the end of Bitcoin, as we know it, is the end of as it was defined in the white paper originally. For instance, how many times now in the last year have you heard the phrase, Bitcoin is a store of value? In the original white paper, it was meant to be a currency. It was not meant to be a store of value. It was not meant to be digital gold. Institutions are now calling it a store of value, and they're calling it digital gold to market it to the masses. It's really easy for consumers to look at something being referred to as digital gold because they know actual gold is valuable. For these institutions to market Bitcoin as digital gold, it's a great marketing plan, and it's a reason why it will take off. But I'm here to tell you that the original OG Bitcoin holders, the people who participated reading the white paper, the people who developed Bitcoin originally, they never envisioned it being a store of value. They envisioned it being a decentralized currency. And currently, worldwide, it's not being actively utilized as a decentralized currency by the masses as originally described in the white paper. It is becoming a store of value, being marketed by these financial institutions. What I say in my videos are just my opinion. They're not financial or legal or tax advice. I'm giving you information for you to make an informed decision, and I want you to be informed. I don't want you to go about and keep hearing the phrase, Bitcoin is a store of value. Bitcoin is digital gold. Because when you really think about it, what is Bitcoin? Bitcoin is a blockchain. Bitcoin is a ledger. Bitcoin in and of itself, they'll say that it's in scarce supply. Well, when these people say it's in scarce supply, if you talk to an OG Bitcoin participant or an investor, when they started hard forking Bitcoin, we all started to realize that Bitcoin isn't in scarce supply. We all were mining Bitcoin. We were essentially printing money. And then you have computer developers and engineers go and split off the blockchain, basically doubling the supply of Bitcoin onto another chain. You can't have a decentralized currency hard forking. It doesn't work. Why would you put your money into Bitcoin and then have it hard fork over to a currency called Bitcoin Cash? So once all these hard forks started going on, a lot of the OG Bitcoin community realized that Bitcoin as we knew it was pretty much dead. Now, as the comment originally said, it will take a global effort to stop Bitcoin. As you'll see in this video, the EU member states are now targeting the digital economy. They want to capture all of our digital transactions to make it easier for them to apply tax to the appropriate individuals and within the appropriate member state. Now, with the EU targeting the digital economy, they're doing it through the EU regulatory environment. However, the EU regulatory environment is also a member of a global community called the OECD. The OECD is the Organization for Economic Cooperation and Development. As an accountant with experience in IFRS and a little bit of knowledge of transfer pricing, I'm pretty familiar with the OECD. The OECD is an integral part in determining transfer pricing for multinational companies. Take, for instance, if you have a company who's developing a product in Jamaica. They are using Jamaican inputs to produce that product, but they may be selling it in another country. Because they're producing that product in Jamaica and they're using inputs in Jamaica, the cost of goods sold price that is going to be transferred to the other nation where they may be selling the product will be determined based on the Jamaican currency. So when that product leaves Jamaica to go to another nation, there is a taxable event within Jamaica. And the OECD basically develops the rules that these nations are supposed to abide by, and thus the companies within these nations when they do transfer pricing. As you can see here, when we pull up the OECD on Wikipedia, you can see that there are 37 member countries, and it was founded in 1961 to stimulate economic progress and world trade. It goes on to say, as of 2017, the OECD member countries collectively comprise 62.2% of the global nominal GDP, or about $50 trillion, and 42.8% of global GDP, or about $54 trillion. Further on the page, they mention taxation, and they mention what I had just stated previously. So now that I mentioned what the OECD is, the question is the OECD also working on crypto regulations? Well, as a matter of fact, they are. In this news article from Modern Consensus, you can see that they are indeed working on crypto tax regulations. A little bit down in the article, you can see the portion I highlighted, and it states the following. The standard that the OECD is working on should be closely reminiscent of Common Reporting Standard that was adopted in 2014 to standardize the information regulators collected from traditional financial institutions and shared with each other to combat tax evasion. The gentleman that they're quoting goes on to say, fundamentally, the idea is to have a standard which would be roughly equivalent to the CRS, if not the CRS. So what is the CRS? We can go on to the next article. This article goes on to state, for brokerages, what are the steps they need to become CRS compliant? And these are what is going to be required for the institutions that are holding cryptocurrency assets or participating in the digital economy. At least that's what the OECD and the EU hope for. Basically, in 2014, if you were a brokerage and you had to adopt the CRS regulation, you needed to be able to do these following things. You needed to identify the tax residency of the person, specify due diligence procedures conducted by obtaining relevant information through your account opening forms, which include consideration of the residential address of the account holder. The information that needs to be reported also includes identity details of the foreign tax resident, the account balance, and other information specific to the nature of the reporting entity. So what this is basically saying is whether or not is it an individual or it's a business, you need to have all this information before you're allowed to conduct business. So the question I ask myself is, why are they now looking into this after 12 years? And as I'll show you in this next PDF, they have actually figured out that they're losing out on taxation revenue. So this is the Inception Impact Assessment by the European Commission. This was just put out on the 23rd of November. They are referring to this, I believe, as DAC 7, and DAC 8 will be the regulation that will be put into play to regulate cryptocurrencies. DAC 7 is to regulate the digital economy, and in this assessment, we go down here, they talk about cryptocurrency. They go on to say the lack of centralized control for crypto assets, its pseudo-anonymity, valuation difficulties, hybrid characteristics, and the rapid evolution of the underlying technology, as well as their form, are challenging in regard to tax obligations. Furthermore, This form of assets can be used for payment as well as investment purposes, which makes its classification and the potential tax compliance even more difficult. These difficulties follow from the need to identify the relevant intermediaries, the reportable event, the valuation of assets, and the available information, among other things. Similar to traditional financial instruments, income derived from crypto assets could be subject to taxation. However, and this is an important point they're making, proper enforcement of tax obligation relies on a proper reporting and the ability of tax administrations to have access to the information. The existing provisions of the DAC, this goes back to when we were talking about CSR, provide for an obligation for financial intermediaries to report to tax administrations and for an exchange of information between member states. They go on to say that for crypto assets and e-money, there currently is no such obligation to report, as crypto assets and e-money, as well as the relevant intermediaries for the assets, are not fully covered by the directive. And hence, the national tax authorities currently cannot get this information from each other. They can't share it. They also realize that the intermediaries can't be expected to have the information. They go on to say that this is particularly worrying in an area where all platforms are digital and therefore easily move their activities between member states and easily carry out cross-border activities. Then they basically say that the level of tax transparency for these institutions and the new technology is extremely low, and that users can create, hold, and transfer assets without third-party intermediaries. And this goes back to my point with Bitcoin. It was meant to be a trustless peer-to-peer play. You now have it being referred to as digital gold. As you can see in this video, the EU is not happy with the fact that Bitcoin was originally set up to be a peer-to-peer, trustless currency. And as you can see, if the EU and the OECD is working together, they both agree on this fact. Now the question becomes, is the EU and the OECD going to agree upon similar terms? So really, to see if they'll agree upon similar terms, we have to go look for the tax director of the OECD and see if they're actually working together. And in this latest article on Cointelegraph, it mentions the OECD tax director. The tax director is Pascal Saint-Amans, and he's the director of the OECD's Center for Tax Policy and Administration. He goes on to talk about the European Commission and basically the agreement that we had just seen previously on November 23rd. He states, despite the action taken by the European Commission, that he expects that the OECD will establish crypto tax standards before Europe, describing the policy arena as an opportunity for the EU to align with the OECD's standards. So what this tells me is basically the OECD as an organization has come together and pre-agreed to what essentially is going to happen, and they will be making the first move outputting this tax policy to the world. The person writing the article states that if there's an uncoordinated effort between the OECD and the EU, that the laws will collide with each other and make it very confusing for the European members. However, in the Law 360 article, when they're talking to Amans, they asked this and he dismissed the concerns. It states in the article that the European Commission spokesman indicated that the organization was working in parallel with the OECD to avoid overlaps and inconsistencies to the extent possible. I will say that I think it's very interesting that the OECD is going to make the first move on this. From a political standpoint, it makes sense to me. What occurs if somebody acts against the OECD's directives is that the members of the OECD can impose sanctions on the nation that rejects their governance agreements. And so what you will not be seeing is the US or any of these other members go against the OECD's dynamics, because the businesses in the United States are multinational and they're not going to risk being sanctioned for going against these proposed tax policies and tax regulations. So that's why I believe the Treasury will indeed announce some changes to how cryptocurrency is regulated within the United States. So what else does this mean for the cryptocurrency environment as a whole? Well, as I stated earlier, if they essentially want to end peer-to-peer transactions and forcefully introduce third-party intermediaries, banking institutions, things like that, Bitcoin as we know it is no more. If you have to transfer Bitcoin from Kraken to Coinbase, and Kraken and Coinbase are now banks, it's not the same for me to transfer Bitcoin to you and to pay for goods and services. Bitcoin originally was anonymous. The blockchain, you could track the wallet IDs, but you didn't know who was transacting on the blockchain. The governments want to remove that capability. Because they're removing that capability, now you have people, as I said before, referring to Bitcoin being a store of value. I think we just need to think critically about this. What's the utility? I'm open for discussion on this. Comment below. What is the utility of Bitcoin? So if they're proposing reintroducing third-party intermediaries into the cryptocurrency economy and essentially forcing KYC and AML upon all cryptocurrency, what does that leave us with? Well, let's take a look at this entity. This is SWIFT. SWIFT is a global institution that is in charge of money transfers across the world. SWIFT is old and outdated, and transactions take an extremely long time. Cryptocurrency was developed to accelerate the speed of payments and give people direct custody to their assets in a timely manner. So what could be better than SWIFT at accelerating the economy and participating in the digital economy? Well, in this same Wikipedia page, we have a list of competitors, alternatives to the SWIFT system. Ripple is directly listed. It goes on to say that SWIFT argued that the scalability issues of blockchain solutions remained unsolved, confining them to bilateral and intra-bank applications. So I think there is just a disconnect and general lack of knowledge on behalf of SWIFT in this idea. You see, when SWIFT mentioned this, I think they had a definite, complete understanding of blockchain in Bitcoin as we knew it, because it was a P2P trustless transaction, and it was meant to be between two parties. It was not meant to supply a ton of information to other individuals or verify that information across third parties. So taking this all into account, we've come a long ways in the 12 years. And as an accountant, I think that there's going to be some pretty remarkable changes in the financial industry. It's going to make companies and governments' jobs a lot easier. It will allow governments to apply taxation to where it actually needs to be applied, and for governments to be able to collect the appropriate tax based on these regulations. What that means for P2P cryptocurrencies, we don't really know yet, and we'll find out with that guidance. I hope you found this informational. I've got a lot more topics that I'm going to be talking about coming up. I'm going to try to get a schedule set up for you posting on YouTube. I'll get back to you guys on what that schedule may be and what I might be covering. If you have any ideas or any input on some topics that you want covered, please comment below, and I'll do my best to cover them. Thanks. I appreciate you watching.